Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 4th of September. I'm Daniel Lam, your host for the podcast. Last Friday evening, I experienced the strongest typhoon in Hong Kong over the last 25 years. The typhoon must have been quite well publicized because Manpreet Gill, my colleague in Dubai, sent me a message to check if I was doing okay. Now, those of you who have been long-term followers of Cut to the Chase would have remembered Manpreet from the earlier days of this podcast. Now, the US non-farm payroll came out that same Friday evening. It may not be as dramatic as the typhoon, but it certainly contained many points of interest. Basically, it suggests that the softening of the labor market is continuing at a steady pace. So if you look at the June and July numbers, they were revised down by 110,000. But for the August number, it came in above expectations at 187,000 versus 170,000. Meanwhile, there was an unexpected increase in the unemployment rate to 3.8% from 3.5%. That reflects an expansion in labor supply with an increase in the labor force participation rate. So the report appears to suggest that while non-farm payroll employment is slowing, the labor market may still be holding up. It suggests that inflationary pressures are continuing to ease without causing a significant deterioration in the economy. However, the rising unemployment rate may suggest that the full impact of the Fed's tightening cycle is still not getting fully transmitted to the economy. There is a possibility of further deterioration in the labor market and the unemployment rate to eventually rise to recessionary levels. So in our view, a US recession is still on the cards for the first half of next year. In the podcast last week, we spoke about how the US and DMIG government bonds offers an attractive risk-reward. We spoke about how the rise in yields have been excessive versus the Fed fund rates, and that was due to speculative short positioning in longer-dated US treasuries. So we are assigning a high probability of a decline in yields over the next 3 to 12-month horizon. Technically, 4.5% is a key level of resistance for the US 10-year Treasury yield. We're expecting the yield to drop to 3.25% over the next 12 months, and there is a chance that it may drop by a median of 260 bips over 22 months, which was historically seen around recessions since the 1950s. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.